Hello friend, in this video I will discuss Markowits theory of portfolio selection, which is examination asked question for IGNOU MA Economics second year course code MECE, that is Master of Arts in Economics elective paper 004. Title is Financial Institution and Market. And before moving ahead on this topic, if you come first time at my channel, please subscribe my channel and press bell icon for all notifications so that you can get my latest video notification easily. Now let us start what is the Markowits theory of portfolio selection. It explains optimal behavior of investor regarding to optimal choice of portfolio. In construction of portfolio, an investor seeks to maximize his expected return from the investment a given level of risk they are willing to undertake. Okay, and it is the based on certain assumption. First assumption, there are four major assumptions on which this theory is built. Okay, and first one is an investor will choose portfolio on the basis of mean and variance of expected return. Means and variance, this is the assumption number one. Means is denoted x bar, sigma square denoting variance. Number two, investor is risk averse utility maximizer. Risk averse utility maximizer. It means risk averse means he does not like to take risks. Avoidance of risk is called risk averse. At the same time, he wants to maximize utility. And assumption number third, investor have single time period horizon. Single time period horizon. These are assumptions and it is the same for all investor. And finally, investor have identical expectation regarding to expected return, mean variance and covariance. Okay, covariance for a risky asset. A set of efficient portfolio is given by risk return indifference curve. You can see how risk return indifference curve is drawn. Horizontal axis risk is measured, vertical axis return is shown, and this is risk return indifference curve. I have drawn three indifference curve representing three different level of utility, and on the basis of risk return space, risk return indifference curve are convex and upward sloping. The steeper the slope of indifference curve, the greater the degree of risk aversion, that is it maximizes utility. That is, it is a clear higher the steeper the slope of indifference curve, the greater degree of risk aversion, that is people does not like taking risks. And any point on a particular on the same indifference curve representing same level of utility. There are 2 points on risk return indifference curve, 1A and B, both representing same level of utility. Higher level of indifference curve representing higher level of utility. Indifference curve 1, risk return indifference curve 1 representing the utility which is lower than as compared to risk return indifference curve 2 representing. That means indifference curve risk return indifference curve 1 representing lower level of utility, indifference curve 2 representing medium level of utility, and finally higher greater indifference curve, that is the indifference curve 3 representing in this graph highest level of utility. And now, given same level of risks, different portfolio will have a different expected return, and investor will choose that portfolio which give highest expected return for a given level of risk. A set of efficient portfolio is a given by Markowits efficient frontier. You can see the red color line representing Markowits efficient frontier. This line is representing. It is, what is it? It is a set of efficient portfolio. And how to choose optimal portfolio? The selection of optimal portfolio is selected at the point at which Markowits efficient frontier intersection point of Markowits efficient frontier and highest possible achievable risk return indifference curve. You can see here the highest indifference curve achievable intersecting Markowits efficient frontier at point P, and point P is denoting optimal portfolio selection. According to Markowits theory of portfolio selection, the point P-MEF is representing selection of optimal portfolio. It is the intersection point of highest achievable risk return indifference curve and Markowits efficient frontier. This is the complete video on the Markowits theory of portfolio selection. And if you like this video, never forget to give like, share as much as you can, and never forget to leave comment on this video. More video will come on my channel covering the syllabus of MECE 4. Title is Financial Institution and Markets. Thanks for watching my video till end. Jai Hind.